Good afternoon, everyone. My name is Gabriel Buck. I'm a banker by background, and I've been a banker for 35 years, having specialised mainly in export credit agency finance. I used to be the chair of the British Bankers Association on export finance and trade for 6-7 years, and for the last 5 years, been the founder and managing director of GKB Ventures. We are an ECA advisory firm. And we are very focused on Africa, and this whole stream this afternoon is about the issues of affordability and sustainability. We're quite a small group here, which is fine, and so therefore I do encourage you to ask questions as we go along. And the big picture to everything that we're doing today, and what we, I think, need to be looking at and addressing as participants here in Africa, is how do we make the debt sustainable and affordable? If you look at what Africa needs, and I'm talking about sub-Saharan Africa, it needs about another $50 billion worth of infrastructure spend per annum over and above what it does already. Most of this, what I would call social infrastructure, is undertaken at a sovereign level. And so therefore, when you're looking at sovereigns in sub-Saharan Africa taking on debt, we do not want, and I firmly believe that we do not want, as a collective, a situation where we're just creating a debt bubble that creates and causes countries to go into default. They've got limited budgets. They, as borrowers, and particularly at the sovereign levels, are looking at making sure that the debt is sustainable on a long-term basis, that the debt is affordable, and that the debt is good debt. And I think the first session we are going to be covering is the definition of good debt and the roles of the export credit agencies and the role of the banks and the role of third-party participants. So I'm still looking to the door, hoping that Portia's coming in, but she hasn't. I'll pull her leg on this, given that we used to work together. But without any further ado, I'm going to, and I have Chris Mitman, sorry. Do we have Chris on... logged in. Chris, did you get all of that?
Yeah, I can hear you, Gary.
Perfect. Okay, I'll take a seat. And Chris, given that you're dialing in, could you introduce yourself? And as part of your introduction, I'd be very keen to get your own personal definition as to what you believe good debt to be.
Which is used for investment in socio-economically impactful and sustainable infrastructure. So quite a few boxes to tick, but the right projects with the right impact, I think, are key if you're going to get into debt.
Okay, thank you. Sujithav.
Yeah, thank you, Gabi, and thank you all. Thanks to GTR as well for giving the opportunity. I am Sujithav. I am from the project and export finance team within Standard Chartered Bank. And as you perhaps know, Standard Chartered Bank, different from other, it's like an emerging market focused bank. So even though our headquarters is UK, our clients are across Asia, Africa, and the Middle East. I am part of the team based in London, looking at countries in sub-Saharan Africa. So I have been doing this for the last 14, 15 years now. To answer the question which you have put to us, Gabi, in terms of what is good debt, I think as a mortgage holder in London, I'm hoping my bank never asks me to pay, right? But that won't happen. And so for me, I think a good debt is something which is repayable. As Chris rightly mentioned, it should be sustainable for all the transactions that we are doing, something which is paid back timely and in full. And of course, it goes on to do some real asset. So we are doing something useful. So it's an asset which is built up, which you can see. I think that is important for us, and that's important in what we do. Maybe I'll stop there. Thank you.
Portia, welcome.
Thank you.
So at the beginning, I was just basically very quickly saying that Africa needs 50 billion in addition to what it already spends in infrastructure. And we need, as a collective in this industry, need to find ways of making sure that the debt is affordable and that it is sustainable. So what I would like you to do is introduce yourself in terms of what you do, and also to answer the question, what is your own personal definition as to what you believe good debt is or should look like?
Portia Dube, and I head up the business development unit for the Export Credit Insurance Corporation of South Africa. Our mandate is to facilitate the export of capital goods, services, as well as investments from South Africa to the rest of the continent and other emerging markets. And until recently, our focus was on the export of capital goods and services, but our mandate has just been expanded to include short-term trade. So that's obviously increased our focus and in terms of our reach, in terms of the clients and the type of transactions that we would normally look at. In terms of good debt, I think if you're looking at, in my view, it would be anything that results in economic growth. So that's why this expansion in our mandate is particularly exciting for us, because I think everyone usually thinks of your infrastructure development in terms of the right type of investments and where support should be put. However, if you're looking at international markets and how economies have grown, they'll tell you that it's been fueled by the SMME sector. And that's a good standard to see how well your economy is doing. And this expansion into the short-term trade and working capital is enabling us to do just that, support the smaller businesses, support those entities that are dealing with short-term trade, 30-day type of limits, but they're exporting more and enabling our economy to actually thrive. So I think if we were talking about, in terms of debt, usually we would think that if it was in our day-to-day, in our personal use, we would look at a car and we'll think maybe that's not the best use of a loan or to get into a debt to buy a car, to buy a luxury car. But if I'm buying a house, something which I can pass on and something that's going to grow in value over the years, there's nothing like bad debt. If it's something where we are investing, especially in terms of anything that will result in growth in our economy, I think that's where we should be focusing our minds on. At ECIC, in terms of growth and development, we are very small compared to the international ECAs. Our reach is not as wide, but our appetite is bigger than, I would say, the international ECAs. And I think that's what's helping us in these current market conditions. It's helping us stay afloat. We have appetite to do more business on the continent and in a large number of countries compared to the international ECAs, because I think we're not just looking at sovereign borrowers. We're looking at the private market. We're looking at mining sectors. We're looking at your smaller, your farming sectors, your boat industry, etc. So I know it's a long-winded answer, but in my view, anything that's there to drive the growth of the economy is definitely good debt.
Okay. I will come back to you a bit later because you're slightly different. And Michael, just bear with me for a second. That you do have to, I'll ask you a bit later, but I need you to think about, you do have to react and support whoever comes to you from a South Africa. So that'll be an interesting dilemma that you may have, and I think the export credit agencies have got. So I'll plant that with you, but come to you later on that. Michael, would you like to introduce yourself?
Thank you. Good afternoon. My name is Michael Fondatakis. I am Global Head of Project, Trade and Export Finance at Baker McKenzie, the international law firm. And I am responsible also for our strategy in Africa. So on a separate, not linked just in that sector, on all aspects of our firm's basic positioning on the continent. In relation to your question, I don't think I can add anything more from a commercial or moral argument of what constitutes good debt. But looking at things the way a lawyer may look at it, what I consider good debt, the other points aside, is something that's bankable and ultimately where the risk is mitigated as much as possible. So for me, good debt is debt that I feel at the end of the day, it will be serviced as it's been decided. Everyone meets their obligations, and at the end of the day, both sides are satisfied with the result. That is good debt, because what you don't want is the situation where you start looking at us to come and help out, to restructure or find other solutions. So that's the one thing that I'm looking for from a legal side.
Okay. Go on.
We've had examples where when you're looking at a transaction, you struggle. There's been instances where we've actually approved a transaction and the financial institutions that we rely upon didn't have appetite to take on the transaction. They will look at a client and they will look at a transaction and think this one is technically insolvent. There's no way that you can invest and put your money there. And like I said, we've had examples where we've supported them in those instances where the financial institutions were not willing to go there. And I'm pleased to say, I think a good example would be what ECIC did with the boat building sector, where we identify the sector, we knew it was struggling, and we put in place a program for to support the working capital and guarantees program for that sector. But for a lot of financial institutions, it was untouchable. To date, we now have some of those clients driving growth and exports for South Africa, winning mandates to manufacture war vessels and Navy ships for international clients, which for me, that's why I say anything that does drive growth and development. It may not look like it from the onset, but if you stand behind those clients, even in the difficult times, I think we view transactions or projects or debt based on what we see now. And I do feel that we do need a more for long-term approach and view in terms of what we support.
But would ECIC say no to a transaction because they feel, even though you're supporting your exporter, you feel that the debt associated with that is not affordable from the buyer-borrower's perspective?
So, I mean, it's a very interesting question because I think if you're looking at, for instance, we have this debate now maybe within the health sector, right? Because with a lot of the transactions that we would look at, we want to see that that it is bankable and that, the revenue generating capacity might be the reason why we choose to go with one transaction or choose not to. But if I take the example of the health sector, can you have, it may not be sustainable, maybe because the government is over indebted. However, I think the last few years have shown us what happens if we do not invest in health, for instance. But if you're looking at it from a public health perspective, if a government wants to spend money on more hospitals and clinics, yes, there's no revenue generating capacity, but what you have is a healthy workforce. You have people who are able to go into the industry. I mean, it sounds like a cliche, right? But health is wealth. So sometimes you have to do the other in order to get to the sustainable.
Okay.
But hold on. I mean, I'm working with African Export-Import Bank, who are creating a center of medical excellence in Nigeria. And it can work if you do it right. In some ways, that way it will keep essentially dollars in Africa. It will stop a brain drain of doctors going elsewhere. And if that works regionally, maybe you could have another similar project in East Africa and another one in Southern Africa. I mean, it's a question of how you look at it. It shouldn't always be this negative thing. If we invest in the health care sector, we're just going to lose out. You can structure it ideally in such a way where it could actually be extremely appealing. And King's College Hospital in London is partnering up to give the expertise to help grow that. So, again, I think it's how you look at it and what angle you take on it.
Okay, so I actually think that, in this industry, we are more Catholic than the Pope. I think there is a high degree of evaluation as to what is good and what isn't good. But when you look at where the debt is, most of the debt that's in Africa comes from the bond market. And maybe this is a question I can put to you, Chris. I'd be interested, Investec is a global bank and it's involved both in the fixed income as well as in the ECA market. But from your own perspective, how would you see the benefits, advantages or disadvantages of financing Africa's infrastructure through either the bond market or the ECA market?
I think, Gabby, both have a role to play. I do, however, think that the ECA debt is definitely the more responsible and targeted source of debt for sovereign borrowers looking to invest in infrastructure. The stringent compliance on use of funds, value for money, strong ESG processes are all good reasons why investors like banks and ECAs are comfortable to support that debt. We've all been talking just now about how good debt can be deployed. ECA debt, make sure it is deployed for the purpose set out in the loan agreement. In bond prospectuses, the use of funds is not nearly as well controlled. The money goes directly to the issuer. There's a use of proceeds clause with a few lines long, and we've seen notable examples where the proceeds actually haven't gone to the stated purpose. I think on the flip side, annoyingly, whilst we're really good at ESG in the export credit market, we're terrible until recently at classifying loans as green or social. The bond market took a massive march on us on that side of things. Well ahead of the market. We are now catching up, and we've got to move away from being completely fixated on ESG, which is a do no harm assessment of the implementation of the project, to looking at the through life benefits and impact of the project, which is what the LMA green and social loan principles are about. Last point I'd make is the bond market, as I said, it's got a role to play. There's investors who are, through mandate, required to invest in liquid instruments. ECA debt is not liquid for the most part, and the bond market did stay open during the pandemic when there was a wholesale retreat by other sources of commercial debt. I think the problem with trying to marry that credit capacity with export finance is bond investors are just impatient. They want to do a deal, they want to do it now. So I think those are the major highlights I'd like to bring out on that, Gabby. Thank you.
Okay, Sujithav?
Yeah, so Gabby, I think I would definitely agree with what Chris mentions, right? So with ECA financing, the clear advantage being the well-defined use of proceeds. Where perhaps I disagree, hopefully, is, I do see his point about the bond volumes, the green bond volumes, and they having stolen a march over, presumably in terms of volumes. But if you look at the ECA financing and the projects that we are doing, I think the bulk of them are going for social infrastructure, for priority projects. These are all priority projects as defined by the government. And there are only so many priority projects which are being done, right? So I think a lot of ECA financing is going for critical infrastructure projects, for critical sustainable projects as identified by the government. And by definition, probably volume-wise, it might be less, But given the advantages, the clear defined user proceeds, I think Zambia is a good example where when they looked at, they did the debt analysis after the default, and they found out that it's the ECA-backed loans which actually had gone to fund important hospitals and water projects. So, and ECA financing, of course, we are not going to have like the tuna bond case here and things like that. So we all know, I think those are the advantages which I would highlight.
It's been a long time since I heard about the tuna bond one, but yeah, that's a classic example as to where money or where the proceeds of money has just disappeared. Michael, do you have a perspective from a legal side?
Yes, but one could say I have a prejudiced view. I agree with everything Chris said as well, but I also try to look at situations where things go wrong. And we saw a lot of things go wrong in the last financial crisis. With debt, not just ECA debt, with loans, it's more easy to amend the documentation. You have greater flexibility, and this is also for the benefit for the borrower as well. If there's an issue, it's more easy to find solutions and implement those solutions. On top of that, if things really become difficult, many of you might have had those experiences with steering committees, ECAs, trade finance banks, commercial banks, bondholders. The view of the bondholder is very, very different, and I think the spectrum goes from the ECAs here to the bondholders there. They want out, and they want out quickly, and they don't look to find sustainable solutions. So, beware, that's all I would say. It is a great source of capital, without question, but please beware.
I was going to pick up on that point as well when Chris was speaking, because that's one of the key things that come across from the clients that we serve, where we've had clients come back to us and thank us because we've stuck with them throughout the difficult times when they were in the bank that would have been put on the back burner and sort of like written off almost. And we restructure, we stay with them because we know it can turn around. And that flexibility from the bond market, as Michael says, is just not there. So I think that's one of the advantages that I think, especially for infrastructure projects, very few projects go according to plan. There are things that go wrong. There's so many things that are unforeseen that take place in terms of cost overruns, in terms of, something as basic as even just the weather, the change in the weather patterns that can then just throw off the project, and in terms of execution and delivery period of the project, and affect the repayment structure. So that flexibility, you find it in the ECA-backed loans.
Okay, that's interesting because you said everything I expected to say, but you didn't say it's going to be cheaper to go through an ECA market than through the bond market. But I'll leave that to one side. There's two topics I want to talk about, or to hear your viewpoints. One is about sustainability, and the other is about affordability. But on sustainability, and I'm looking to you, Chris, here. There's a lot of talk in the market, but what is the reality? Is the ECA market moving to more sustainable facilities? And I know that you've been very heavily involved with the ICC and the SEF working group on this. I'd be grateful if you could just give us, the top 3 or 4 objectives of that and what you have seen coming out of that.
Sure. So it's been a journey. The white paper on sustainability and export finance was published in September last year during the UN General Assembly. And for a short while, export finance was famous outside of the market of export financiers, because until that paper came out, I'd argue that we really weren't a very well-known market at all, and certainly not as a market which can help governments and investors meet and invest in the sustainable development goals. It was like a closed shop, and I've said it in other platforms, and I'll say it on this one that it's a market which is relatively unknown outside of export finance practitioners. And so the white paper I think, played a role in putting it out there. We even got coverage in the FT when that was launched, which is rare for export finance. I think a couple of points to note then, to answer your question, Gabby. The white paper is global. It's not just OECD ECAs, it's non-OECD ECAs we're talking to. It is helping instruct institutional and market conversations. The working group has been active, engaging with the Bern Union, the OECD practitioners meetings, as well as individual national industry associations and ECAs. We've also participated in the Export Finance for the Future group of 7 governments panel late last year as well in The Hague, where export finance is increasingly getting recognized. Remember, that's 7 governments, not 7 ECAs, who got together recognizing the direct role export finance can play in helping deliver on the SDGs, including number 13, climate. I think in terms of the priorities for the working group was, well, we took a deep breath after the publication of the paper, but then we decided, what do we do now? It's launched, which is hopefully see some traction from that publication. So as a group, our key priorities for 2022 are, number 1 is defining what a green or social export credit transaction is. It sounds like an incredibly modest ask, but so far, if you look at the OECD survey, which came out late last year amongst ECAs, is everyone's doing their own thing. They've got their own methodology. It's crucial for us as a market that we use the same definitions and frameworks to help measure what's green, social, and sustainable. Because why is that critical? Because consistency in reporting to stakeholders is very important. Stakeholders being shareholders, government shareholders, but also investors in export credit deals. We've closed a couple of transactions late last year and a couple of investors came into those because they were convinced as to the social impact of those projects. And there will be no accusations later of greenwashing, etc. So number 1 priority is the definition. Secondly, OECD engagement on the modernization. I'll say not much about that other than it's being modernized. The whole world is looking at ways to address the climate crisis and the SDGs. The modernization must take account of those as it progresses. Next up is ECA engagement, non-OECD as well as OECD, very important. Another point is social export credits. This is entirely missing from the narrative right now. If you look at the Bern Union, there's sort of a climate working group. The clue is in the name, climate working group. It doesn't talk about social infrastructure. It just talks about climate. The ICC are represented on that group, and we're trying to get social infrastructure included on the terms of reference for that committee. Interestingly, there is a proposal just come out to the EU, to the EC for a framework, a taxonomy for social infrastructure as well. This is just reasonably recent news, which may help feed the narrative at the government level. But right now what we're seeing is European taxonomy, EU green taxonomy, principles being exported effectively to developing markets, which is just not appropriate. It doesn't take account of the social overlay. Last point I'd just like to make is, apart from obviously the engagement with the Bern Union, which has been excellent, is looking at the trade register, which we set up, some banks set up with the ICC in 2007. It's become an incredibly strong brand in terms of promoting export finance to government stakeholders and regulators as to it actually performing quite well. It's changed the whole discussion with those regulators on risk. The question for us as a committee is whether it could also be used to look at loan performance for social and green loans. There's a massive data there going back to 2007-8, where you could look at performance of government, corporate, and projects in that space.
Okay, Chris, I may stop you there because what I want to do now is we've heard those 5 points: define, modernise, ECA engagement, social as well as climate, and the trade register. I'm going to put this really to the banker and to the Export Credit Agency. With that, 2 things. 1, is this making you do more of this? And if so, why is that an incentive? And 2, is it stopping you doing other things?
Go first.
Well, yeah, it's a very interesting one. I think for me, in terms of the definition and the standardized approach, I find it very difficult when I look at the continent, because if we look at what, as a South African ECA, we're supporting South African expertise. We also looking at what's our strong point. If we take an example of what's polarizing a lot of us right now, it's like if you look at mining. And
Okay, I'll give you one. What about if you're doing a coal-fired power station, small coal-fired power station, to provide grid electricity to remote areas in Africa?
correct. So that seems like a good thing to do, right? But because of the way the rest of the world is, that's why that standardized approach may not work.
Exactly. So that
Because what's standard for Europe may not actually be the right fit for us right now on the continent. And I would rather we looked at an idea, or we assessed things, and it can't be one size fits all. We need to be able to see how we can support and maybe encourage cleaner technology, but still enable us to utilize the resources that we have, which would be coal, to still provide a solution, which is electrification and development for our continent. Yeah.
Sujithav.
Yeah, so I think, Gabby, in terms of the transactions that we are doing, right, on the ECA space, so as I was saying, the bulk of this are priority infrastructure projects. Now, most of it would be qualified as social, right? They would not be under the green umbrella. They would all classify as social. So that is one thing, and just because of the nature of the things that we are doing, this is all priority, this is all critical. Whether it's stopping us from doing anything else, not really, though the banks we have our own transition agendas, and we have to be carbon neutral, and sustainability is like really big. I'm just amazed the way it has grown now, and I think it would just be like coal. Even if it is for offshore rural, it will be just impossible for us to touch. So we are driven by that. So to an extent, there is an impact, but thankfully in this ECA space, at least, I think we are doing key infrastructure projects.
Michael, quickly, if you...
Very quickly, I remember post COP20, when I was asked by a bank to pitch for their last coal-fired project. I don't agree with that necessarily. I'm completely for sustainability. I'm completely for changing and moving towards these things, but you cannot apply those standards necessarily here. This continent has not polluted anywhere near as much as other parts of the world. And I've heard it many times. We're last in the vaccines, but why are we first in the queue to essentially carry the burden of the North? So, I'm sorry, I'm convinced by that argument. We need to get our priorities right. We should clean up our own shop before we start to apply those measures here. But that's a personal view that maybe isn't necessarily the appropriate view to voice in this green world we are moving in.
And actually, there was a very interesting comment from the gentleman from Bank One this morning, where he was saying, look, the average income in many countries in Africa is $2 a day. How can you ask them to be paying for affordable renewable? Right?
Yeah.
But anyway, okay, that's interesting. I would like, if I may, go into the issue of affordability, okay? So this is really, for me, we've got huge volatility in FX. We're going to have huge volatility in commodity prices, both import and export of commodity prices. Interest rates are going up, and there's going to be volatility in that. And as I said at the beginning, we all agree that Africa sovereign is going to be taking on more debt for its social infrastructure. So separate from sustainability, I'm looking at the issues of affordability. How do we, as an industry, make these transactions more affordable? Particularly even if we just looked at social infrastructure. Who would like to start?
Yeah, okay, I can try. Oh, Chris? Yeah, please.
Chris, go on.
Yeah.
Thanks. But okay, I'll give it a go. So affordability is a product of pricing and tenor of debt, I guess, to start with the obvious point. So I think to make transactions more affordable, Gabby, you made a good point. I think we did some analysis of export credit versus bond pricing over the long term. Export credit is already about 2/3 of the price of an average bond deal. So it's already on the price side relatively well priced, I'd argue. Trying to make it even better priced, you don't have the data right now. To go back to my trade register point, we don't have the data, the credit risk data, to argue better pricing from a regulatory perspective at the moment. Even though it's been spoken about, we just don't have it. What we do have the capability of doing is to look at tenor. That's a really quite simple ask, I think, as part of the OECD modernization. Against the backdrop of the DSSI, debt affordability, we're seeing, as Portia said, masses of infrastructure investment in medical facilities. Hospitals cost money to build, they then cost money to operate. If I invest in a hospital, it's a very expensive proposition, and then even more expensive to operate. If I invest in a wind farm, I make money once the wind starts blowing. And yet export credit gives 18-year repayment terms to wind farms and 10-year repayment terms to hospitals. So one of the recommendations of the white paper...
I'm going to stop you there. So Portia,
Yeah.
on that point that Chris is just... Why is it that the ECAs, which I think where Chris is coming from, why is it the ECAs allow 18 years for renewables but only 10 for a hospital?
That's not ECIC's experience. So I think that's what kind of sets us apart in a way, being an African ECA and understanding the problems of the continent. I know with the OECD rules and regulations, there's guidelines for each sector, but for the most part, we've supported transactions where we've engaged directly with the client, with the sovereign. We've understood their needs. We've accepted and we've extended the 18 years or the 20 years that they need. But
for social infrastructure?
Yes, but then we struggle to get a financial institution to come in and support.
It's never a perfect world. Sorry, okay. Chris, I interrupted you. You want to carry on? So
No, happy. Interrupt away. I think so the white paper recommendation is that social infrastructure, housing, education, health should benefit as part of the modernization from longer terms. Remembering that the OECD arrangement does only represent about 30-odd% of the total global export credit market. So it has to be cognizant of affordability of debt, and part of that, which is easy to do without further analysis, is extending payment terms. So that's a key recommendation. I think, could banks offer lower pricing on green or social deals? We're not seeing it much at the moment. We're seeing targets set. If you look at the outcomes of the survey and interviews done as part of the white paper, there's a raft of different initiatives being taken by banks. As Sujithav said, it's come out of nowhere to become a major plank in what banks do.
Okay, I'm going to pass that really to Michael. As a lawyer, lawyers see everything. You see the good, the bad, and the ugly. Are you seeing banks in reality? I'll come to you, Sujithav, in a minute. Are you seeing banks in reality really reduce their price for sustainable projects? And I'll come to you also, Portia. Are you reducing your premium for sustainable projects. Michael?
I mean, I'm a cost center in all of this. You shouldn't be looking at me. We're an added cost. But overall, I was talking to a particular bank, and I was also talking about why aren't we getting tax breaks? Why aren't let's say, northern states, are you getting a tax break for doing these sort of, and they said no. And they said, actually, no, I haven't seen them reduce their pricing, but they do actually benefit lots of times from selling down to investors who want to buy and have green products. So ultimately, I think more could be done. More could, I think banks are squeezed. They've been squeezed for years. Interest rates are very low. There's not much they can do by offering lower margin. But the question ultimately is, how can this debt be treated by other investors, by governments and so forth, in order to be able to pass down a cost saving of some kind?
What's the Standard Chart position?
Yeah. So, Gabby, for sustainable projects, the bank does offer a capital relief, if I'm not mistaken, 25% capital relief, but these are not for sovereign transactions, it's for project finance transactions. But it is a move which has started, so at least we have embarked on that journey. So we'll wait to see, if it actually moves on to sovereign. Now, having said that, now for the ECAs also, and I can tell you we have experience of that, and when we brought to them transactions on sustainable, the sustainable projects, they have reduced the premium. I'm talking about, ICIC and the World Bank and others. So we have seen that happening, okay? And in terms of affordability, for instance, I will tell you, Angola was under so much of stress, right? And there were all the discussions which are happening with the Chinese creditors, for the debt moratorium and everything. And in the middle of all of that, we arranged about $1 billion for a water project, which was World Bank supported. And I think, and it was a longer tenor. So we are also seeing a lot of engagement, a lot of involvement of these, the other agencies coming into this space. So they are not restricted by the OECD concerns. They can do 100% of the contract. Of course, the ECAs are definitely, in terms of pricing, is the best, and UKEF, ECIC are one of the best ECAs to work with. But we have seen that. So that was some of the examples.
Okay. Yeah. I've got a question that's been poised or about to be poised.
Thanks. Can you hear me?
Yeah.
Hi. Ed Harkins from GKB. I work with Gabby. I was just wanted to pick up on Michael's point about why should Africa be paying for renewables? And I think the answer is, I'd be interested to see whether the panel agrees actually, is that Africa shouldn't really have to pay for renewables, that we should be encouraging them and to actually take renewables. And how can we do that? Changing things like the OECD rules on renewables and sustainable projects. How can it be right that a defence project, which by the way makes up a very significant amount of export credit portfolio these days, I think it's 20-30%, it's one of the biggest sectors. You can have the lowest premium that you want, you could do whatever you like, they don't need to report to the OECD. So what I want to put to the panel is, the answer in my opinion is to make projects much more affordable, to encourage people to do that, lower premiums, zero premiums for health, for sustainable projects, have clear rules around what is sustainable, to pick up on Chris's point, because it's not 100% clear exactly what it is, and perhaps some more proper reporting from banks about exactly how much of their book is sustainable versus non-sustainable. Because I think, again, if there was proper transparency around how much banks are doing to support sustainability, it might help to give them a little nudge to do a little bit more.
And the question? Sorry, Ed.
Well, does the panel agree? That's affordability. So what else can be done as well? Because that's what I think.
How do we move the dial?
But I don't think the answer is more coal for Africa.
No, I'm not saying that, but I don't think the onus should be imposed on the continent. I think we have priorities on the continent that need to be addressed. But I personally would like to see more from our end up north in Europe or elsewhere to assist, to find ways by which to make it more how would I put it, appealing to move to a more sustainable. I'm certainly very green in my view of the world. I'm not one of those people who denies whatever, climate change. I think it's important we tackle that, but it shouldn't be left, the burden shouldn't be left to those who need the help most. That is what I'm saying. I think we should be shouldering more of that.
Agreed.
In the developed.
Agreed. Can I chip in there, Gabby?
Go ahead, Chris.
I think the Angolan water deal was sort of a case of almost the development banks replacing ECAs as a relevant source of capital for Angola. I wouldn't even characterize it as a co-finance, such was the proportions of ECA debt relative to the total. But what's lacking at the moment, E3F is an encouraging start as to what Europe can do to this point, is 7 governments looking at what they can do. But it's just been looked at through the ECAs. It's not a whole of government approach. So we're seeing the department which dispenses aid rarely talks to the department which promotes trade. In most countries, they're separate and the mandates are separate and jealously guarded. And a whole of government approach which could lead to blended finance packages being made available for certain sectors, because the aid is already being spent. So it's not like there's not the budget there already. So mixed credits, affordables, whether it's commercially driven like the Angolan water deal, where a bank brings in a variety of players to put the right solution on the table. But more importantly, what whole of government approach could be taken by the Europeans in particular and the North Americans to help Africa afford to invest in these areas.
Okay. Unfortunately, we're running out of time, so I'm going to wrap up with a big question. So I was looking at one ECA recently and looking at their portfolio of their existing exposure. Now, one has to bear in mind that that's an existing exposure today based on what they've been booking for the last 5, 6, 7, or 8 years beforehand. And what was quite stark about that, about 80%, actually it was about 75% of what they had were in what I would call carbon-emitting sectors, okay? Aviation, defense, oil and gas, petrochemicals. I mean, it was just horrific. And that 75% assumes that the other section was all green, okay? Now, there's a lot of talk about changing that, but when you look at the data for the last 5 years, the amount of, whichever the classification of what is sustainable, the sustainable kind of green element is only about 20% of the total portfolio. Small. So my question to you is, if we're all going to move to do more and do less of the other stuff, what 2 or 3 things you would personally want to see changed that would encourage you to do more sustainable, more affordable, and less of the others? You can see we didn't script this question. Portia.
So, I mean, to ask me that question is a bit tricky because I think unlike the European ECAs, where there's more control in terms of the type of projects that you choose. From an ECIC perspective, yes, we can say we're on cover or off cover, certain sectors, certain jurisdictions, or whatever, if we choose to. But we do not drive the market as such. We do not lend. We don't have SIR rates.
No, but you could change your premium rates. You could say, I'm going to charge more for doing this and less for doing this.
We would still be the most competitive ECA because already as things stand, our portfolio is very diverse. In terms of the type of projects that we support, water, hospitals, mining, across the board. And our premium is competitive. I think those who have come to us in comparison.
But what would you do to change the dial? What 1 or 2 things you would love to do, even if this is on a personal level rather than a corporate level or corporate ECIC perspective?
I would like to see South African companies be able to develop more of the cleaner technology to enable us to still support and make use of the resources we have on the continent. But you find even when we want to support the cleaner technology type of projects, we do not have the expertise.
Okay.
So we need investment in that.
Okay.
In that sense.
Yeah, I think that's a very good question, Gabby. So if I go back and, if I look at our portfolio of transactions in the ECA space, you are, correct. Like if I look at 5 to 6 years, and it's true for banks as well, that bulk of them perhaps would not be sustainable, but they would definitely meet the social classification. They would meet the test of critical key infrastructure priority projects providing benefits, because how do we define a critical road project which is transforming for an economy for a small village? That is also important. So while the point which Ed raised was great, right, in terms of the premium and the differences premium, perhaps of if those critical road projects as well perhaps could be done with a lower premium or with a higher direct funded tranche, something like that. So what UKF does, if other ECAs were also similarly to provide those, that would be wonderful. We would welcome that as a bank.
Michael?
Not sure I can add anything more, but the key thing to me is when we talk about sustainability, we talk about ESG. The G element tends to be a bit small right now, and probably that's fine. We've concentrated on the E heavily and less on the S, and we do need to do more on the S. Yes, I'm not the commercial guy. I don't know how best to fix it. I think more incentives need to be there to encourage the transformation. But let's not forget that the social is as important as the environmental. And for this continent, maybe the social needs to be more of a priority, and let's get the environmental sorted out in other places first. So at least that's the way I view it.
Chris, top 3 things to move the dial?
I'll say it again because repetition is good. Longer repayment terms for social infrastructure. That will significantly shift the dial. And classification of projects. We closed at Investec almost €1 billion of green and social transactions in Ghana last 6 months. Those loans were all classified under separate SPO, second party opinions, as either social or sustainable. That helped bring investors into those deals, including our friends at ECIC there, hi Portia, to help support the financing of those projects. And those projects were led by African-based EPC contractors with a high level of local participation and long-term participation. That's what I'd like to see more of.
Okay. I'd like to close, but I just wonder before I do are there any questions from the audience here?
Yeah, actually I have one. Hi, Gabby, everyone. I'm Alaric from Deutsche Bank. One remark on the affordable of the debt. This is about having a grant element when you structure a financing. So if you have a concessional tranche and if you have a commercial banking tranche, you can reach the 35% grant element that a lot of Africa countries want to have. And I think there is a lot of appetite from that, from DFIs, this what we call project mixed. So what do you think about that? That's maybe a solution for making debt more affordable.
That's a very good point as well, and we all struggle with meeting that grant element. So, but with if we use the SIR rate, right? So, probably it gets you there. It doesn't reach to 35%, and I do know that for some of the countries, the banks, as you rightly mentioned, can come in and provide the grant element, which favors the contractors from those couple of countries. But to the extent we could do that, as I mentioned, the direct funded tranche, if other ECAs could also, what UKF is doing and could be done, that would be wonderful. That would help us get there. So yes, to answer your question, of course, that would be welcome, and that will go a long way actually in doing more projects.
Well, you've just stolen my thunder because I actually said, well, I was going to say the 3 things that I think we need to change the dial is one, full access of the OECD SIR rate. Two is concessional finance. You have to ask yourself, why is it China dominates the African market? Because they offer concessional finance. It fits within the IMF and the World Bank. Unfortunately, from the UK perspective, we have no concessional finance. So for any UK contractors here who are doing social infrastructure projects in Africa, which is under an IMF and World Bank program, you might as well stay at home because you cannot provide a solution. And the third thing is flexibility. I think if we want to change the dial, we should be asking for social infrastructure or green or sustainable projects to have the same flexibility as under the OECD rules as the defense market gets. Okay, which at the moment, the defense market has complete flexibility. And unless we have the same as they are able to obtain, then we're not going to move the dial. But that's how I'm going to finish here. I just want to thank my guests for everything, and we're slightly late, and apologies for that, but thank you very much for your input and your...
Thank you so much, Gabriel. Thanks a lot.